Welcome back. We're going to be doing a stock analysis on Facebook/Meta. Their ticker symbol right now is FB, but it's going to be changing to MVRS in the near future. Alright, so they have a $960 billion market cap right now and are selling for about $345 a share. So just like Google, this was another one of those big tech stocks I started seeing in 13F filings of pretty famous value investors. So I did a deeper dive and I found a lot of interesting things, and I think it's going to make a pretty informative video. So I hope you enjoy it. Alright, let's get started with the share price history. So what I have here is the last 6 months. And you can see it had a pretty hard fall from September to like late October, almost 20%. If I do like this, yes, 16, 17%. We've recovered a little bit. Is it going to continue to recover? Is it going to surpass the previous high? I don't know. I'm about as far from a technical trader as you can get. But what we are going to do is look at the financial statements, get a valuation, and see if we think it's under or overvalued. All right, so let's do that, starting with the income statement. First up, as always, total revenue, top line item. You always want to look at this first, really to just make sure it's not shrinking. And this is definitely not shrinking. This is just like the other tech stock we looked at, exponential. So I'd love to see this. We're not going to get a valuation, but this growth in revenue's got to be worth something. All right, and like I talked about before, we're not going to use gross profit or gross profit margin for tech and service companies because they don't have as much equipment to maintain and they're not reselling products as much. So what we're going to do instead is look at our operating margin as a percentage of revenue. So what this is all of your gross profit, like we normally do, minus all of your operating expenses. Operating expenses include things like selling, general administrative expenses, SG&A, also research and development. So what we have here is what's left over divided by the total revenue. So look at this, 40% hovering around. That would be a great gross margin. So to have this as an operating margin is incredible. I think over 20 is great for operating margin. Great sign, just like the revenue. So far we're 2 for 2. And next I want to show you something interesting. It's a way to look at the debt load of a company without even looking at the balance sheet. You still always want to look at the balance sheet, but this will give you kind of a heads up of what you're going to find. So this is interest payments divided by your operating income, and then that's a percentage. In general, over 20% would be terrible. You do not want to have 20% of your operating profit going to interest payments. That means that you're in so much debt and that any downturn in your income would really put you in danger of not being able to pay off your debt. So look at this. It's 1%. Like I said, the bad range is over 20. The good range is usually under 10, and there's a lot of companies in that 10 to 20% range. They're at 1% right now. 1% of their operating income is going to interest. They must have very little debt. And that is always a great thing to see in a company. So that's also a great sign. All right, now we're going to go to our first valuation metric, our pre-tax income. So look at this pre-tax income. This is amazing. This is growing about the same rate as that revenue that we looked at that we said was great. And we expected that because the margin was flat. So if the margin's flat, you expect your income to be about the same as your revenue, right? So what we're going to do here for our valuation, I'm going to be a little conservative just because this last quarter came in low and just do the trailing 12 months. So I'm going to do the last 4 quarters. I'm summing them down here. They sum to $47.6 billion. I'm going to round up and say that my pre-tax income is going to be $48 billion. So $48 billion. All right, so next we're going to look at growth. And remember, whenever we have flat margins, I do use revenue to get the growth rate just because it's usually a little cleaner data. So I'm going to do that since we saw our margins were pretty flatlined at 40%. All right, so in 2016, they were making about $10 billion a quarter, and now recently they're at $25 billion. That's going to be an insane growth in 5 years. 25 divided by 10, that'd be 2.5 times in 5 years. I'm going to be even more conservative and say that they're only going to do 2 times in 5 years. So 2 raised to the 1/5, that's going to give me a growth rate of 15%. I think if you're ever getting a growth rate above 15%, you need to really make sure you're not being too overzealous. High growth rates will really skew your valuations, and high growth rates are hard to sustain. So just always be careful assigning large growth rates to companies that are already big. All right, and last is going to be our earnings per share. Remember, we always use diluted earnings per share. And we're going to take the last 4 quarters, sum these last 4 right here. And that's going to go into our valuation at the end as well. So the last four is $14.01. So I'm just going to put $14. All right, let's move to the balance sheet. That income statement was incredible. Let's see if it continues to the balance sheet. We're going to go straight to tangible equity per share, tangible book value per share. This is all of the assets, everything Facebook owns, minus all of its liabilities, everything it owes. And then we're also going to subtract out all of its intangible assets. And then we divide by the number of shares. So what we have here is growing, which is a must for me. If you want me to invest in a company, this has got to be growing. All right, so let's look at our return on tangible equity. So what we do, since this is tangible equity per share, we're going to take our earnings per share, which was $14, and divide by the most recent, which is, look, right here at $40 a share. So 14 divided by 40 is 35%. That's insane. That's awesome. Love to see that. And our price per book, we're going to take the share price, which is $3.45, and divide by 40, and we get 8.6. High price per book value, but that's okay. It doesn't really have a lot of assets, and it's earning a huge return on that equity. That is worth a high book value in my opinion. Great balance sheet. You can see we didn't even look at debt. We kind of touched on it already with the income statement. I know it's going to be low. I mean, you can look at it on your own, but if you're paying that little interest, 1% of your operating income, you're going to have low debt. So I'm not even going to look at it. All right, so let's go to the cash flow statement. First up is going to be free cash flow. This is great too. This is growing. You always want your free cash flow to at least be following the same pattern as your pre-tax income. If it's not, you need to be very, very suspicious because something fishy could be going on. All right, so let's see. I'm going to take the last 4 quarters just like I've done so far for everything else. Let's just keep it consistent. I think we're going to get a pretty conservative value with this company, but that's okay. So I sum the last 4 quarters and I get 35.8 billion. So I'm going to put 36 billion in my free cash flow, 36 billion. And now look at this. This is awesome. Repurchase of capital stock. They spent almost $14 billion buying back stocks in Q3 of 2021. So if you remember what I talked about before, a company buys back its own stock whenever it has excess cash and it doesn't think it can get a good return on that cash if it put it back into its own business. So how do you know what it thinks it could get on its cash whenever it put it back into its business? So if a company puts the cash back into its business, it's either going to reduce debt or increase its assets. And either one of those increases equity by that same amount. So to assume what they could get on that equity, you look at their return on equity, which we just said was 35%. So the fact that they're spending $14 billion buying back shares instead of putting it back tells me that they think the stock could have over 35% upside. So just to put that into perspective, the 345 times 1.3, they think it could be as high as 450. That's awesome. This is a great sign for a company to be betting this big on its own stock and thinking that it's going to continue to grow in the future. Maybe I was wrong to be kind of conservative with those growth numbers. Maybe they have high internal growth numbers. Love to see that. Wow. So let's move to valuation and see what we get for ourselves. All right, first one, rule of thumb method, old tried and true. Pre-tax income times 10 divided by the number of shares. So our pre-tax income was 48 billion for a year times 10 divided by the number of shares, which was 2.78. And we get a target price of 172. Or 173, I'm gonna round up. In general, this one's gonna be the lower of all of ours. This one's probably my harshest judge, but it really just doesn't take into account growth. But I think it's okay. It acts as a nice balancing act to make sure you don't do a complete overvaluation on the other ends. All right, next is going to be our earnings per share Ben Graham formula. So that one is going to be earnings per share, so $14 per share times 8.5 plus 2 times our growth. So 2 times 15. So look at that. $540 a share. Wow. That's awesome. And then the last one is going to be a discounted cash flow. So what we do here is we take our free cash flow, $36 billion, our perpetual growth rate, which is lower than our other growth rate. But if you remember, I went conservative with the 15%, so I'm going to go 10%. And then a discount rate, which mine is always 15%. And we get a market cap of $818 billion. So 818 divided by 2.78, and we get 294 for the share price. So we got 3 numbers. One of them comes in right in line, I think, with the free cash flow. That one is usually the most accurate. The pre-tax, like I always talk about, is harsh. And then the growth one, that relies heavily on growth. I think combined they gave a pretty fair valuation, and that number is 336, and that's right in line with the share price. I mean, it's a little bit lower, but it's pretty close. And if you remember, we used very conservative numbers, so this stock could have some serious upside. So let's talk about that quote up top. So that quote comes from Deng Xiaoping, forgive the pronunciation. He was a successor to Mao in China, and what he did was, even though capitalism was viewed as the enemy and a bad system, he adopted capitalistic principles and pretty much brought China out of poverty into the superpower that we see him as today. And that quote is his way of saying he didn't care about the morals of capitalism compared to the virtues of communism, because it made more money. And a lot of people use that to justify investing in companies that they may not agree with the morals. And I know Facebook might fall in that category for a lot of people. But I guess in Facebook or Meta's case, the quote should be adjusted to, I don't care if the cat is a cat or a lizard, as long as it catches mice. I'm sorry, that was way too easy. That's all I got. I hope y'all enjoyed it. Please like and subscribe. I'll see you next time.